Hey everyone, it's Mike from Orderflows here, and welcome back to my channel. I'm glad you could join me for today's video, where I'll be talking about the pluses and minuses of trading a time-based chart versus something like a range-based chart. Because this is a question that I get quite often. I see it come up in the comments. Which is a better chart to trade. And I want to spend some time sort of going through the differences. And again, when it comes down to choosing your chart style, it is really a personal preference. I mean, I could make recommendations on what I think is a good chart to trade in terms of time-based or volume-based or tick-based or range-based. And at the end of the day, you're the one that's got to trade it. You're the one that's got to pull the trigger on trade. You're the one that has to manage the risk. So before I jump in, if you've been enjoying these videos, be sure to subscribe to the channel, click the notification bell so you don't miss a new upload when it comes out. And if you find today's video helpful, be sure to hit the like button for me. And if you could leave a comment sharing your biggest takeaway, I'd appreciate that. I love hearing your feedback. Your support does go a long way in helping me motivate me, rather, creating more content just like this. So if you're getting value from this channel, be sure to subscribe. Now let's go ahead and get started on today's topic. All right. So time-based versus range-based. Now, especially when you're looking at a footprint chart, when you're looking at volume, right, the way you format your chart is going to make a difference in what you're seeing on the screen. Okay, so this is a range-based chart. This is a time-based chart. This is the euro currency, right? I chose the euro currency because it is a market that I've go back and forth using a time-based chart and a range-based chart. I keep actually both of them open. I'm going to talk about some of the benefits of using it. Now, when people use a range-based chart, right? This is an 8-range chart. Now, again, what's the optimal range that you're going to use for a market? Well, I think it depends on the market you're trading. I find an 8-range chart in euro currency and most currencies to be fine. Some people like 6, some people like 10. It really comes down to how you're going to manage your risk, because it's one of those things where when you're using a range bar and you're trading breakouts, right, you're going to have an idea of where your support and resistance is based off of chart structure. Okay, now traders will argue that a range-based chart removes noise from the market, right? Because it's going to filter out non-meaningful price movements and help you just focus on significant price action. Okay, well, at the same time, they argue that on a 1-minute chart, it includes all of these minor price movements, right? Rather than filtering out the noise, which, ideally, you do want to filter out noise, but really what is noise? Noise is the market facilitating trade. It's what the market does. And when traders think of noise, right, that often leads to overtrading. And with a time-based chart, right, the bar just closes. It's based on time, based on anything else, how a bar forms, 60 seconds, right, if it's a 1-minute chart, 30 seconds if it's a 30-minute chart, while a range-based chart, when it breaks out of that range, then it's going to form a new bar, right? It's going to be a fixed range on each bar. So that, each bar is a certain amount of ticks, right? On the 8-range chart, it's going to be 9 ticks. But is it going to change your form of analysis? No, but it's going to give you sort of different entries and exits. So for example, right, this is the high on Friday, right? Friday morning, 9:17 in the euro currency, on a range-based chart. What do I see up here that's bearish? Well, I see the bearish prominent point of control, right? I see supply coming into the market in the order flow, right? It's slanted a bit heavier on the offer side on what actually traded, right? The delta is positive, so I know that there's got delta of 137, so I know there's 137 contracts more traded on the offer than on the bid. So that's a sign to me of supply coming into the market. I've got the value area, value area is in the middle of the bar, which is where you'd expect it to be. I got the 2 buying imbalances, and I got that big wick up there. Candle closes, on its low. Next candle opens up. Similar thing. Now I don't have a bearish prominent point of control coming in here, but I've got the value area up near the top of the bar. Again, I got some aggressive selling coming in, so it's bearish, at this high. Okay. Now, does that mean that what I'm seeing on the 1 minute chart. So the 1 minute chart is basically these two bars that I'm looking at here and here is taking place in this 1 minute bar. I still got now here, the difference is now I have a divergence, okay, because I have negative delta. On the 1 minute, I'm sorry, on the range-based chart, I had positive delta still. Okay, so that's one of the differences. I still got the bearish predominant point of control. I've got one buying imbalance in here, and I still got my aggressive selling taking place here, right? Then the next bar, I got the bearish ratio, and it's starting to trade down. Obviously, a lot of aggressive selling taking place in this bar. Got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 selling imbalances in this bar. So I know it's quite strong already. And again, bearish bar here at the high, second bar, also bearish bar. And again, that's coming in, these two bars, goes from 53 down to basically 108.29, 108.30 here, okay? So obviously the bar at the high is bearish, next bar is also bearish. On the range-based chart, obviously bearish bar on the high follows up with the bearish bar, and you're seeing sort of it get split up in here. These from about this price level in the bar, 108.29.5, up to about here is one bar on the minute-based chart, okay? But here on the range-based chart, it's split up. Now, can you get in earlier? Oh, of course you can, right? You're seeing already the bearish development come in here because it's split up over two bars. And if you're trading the range-based chart, right, 917.28, 917.39, these two bars very bearish. If you're trading the minute-based chart, you're not getting in potentially until 919. So you're getting in a little bit later, maybe a minute later than on the range-based chart. But you're still seeing a lot of the same things. This is the thing that I've noticed with a lot of traders is I see it with a certain group of traders actually. They always talk about you got to look at the higher time frame, higher time frame, higher time frame. But the problem is if you're using order flow, the best way to use it is as soon as you see it happening in the market, right? So if you're using a range-based chart, you're seeing it right up in here in this bar, maybe even this bar. Okay, maybe you're not convinced right now at this high, but after the second bar, you should already be convinced, and you should be looking to get short at 108.45. Okay, 108.45 is right here. If you're on a range-based chart, or sorry, a time-based chart, you might not be getting short till about 108.40. So, you're giving up about 5 full ticks. Euro currency trades in half ticks. Excuse me. So that's one of the benefits, of using a range-based chart. But one of the things you got to remember on a range-based chart is if a market is in fast market mode. Okay. Now, obviously, if you see stuff like this on a footprint, market's fast market mode. The software NinjaTrader can't handle the data that's coming out because it's just coming out like a fire hose, like water in a fire hose. It's just overwhelming, and you get some weird looking footprint just like that. Okay. Now here, right, if you can't recognize, this is for me one of the drawbacks of range-based charts, because I used to use range-based charts a lot, I'll say almost exclusively in the past when markets were a bit calmer, right? Obviously, when COVID hit the markets back in 2020. Markets went in, VIX was so high, markets were in berserko mode, big ranges on, big ranges on a time-based chart, but on a range-based chart, you can imagine. So look at this. This is 903. Okay, this is 902 in 55 seconds. 903, 00, 07, 09, 14. So within 20 seconds, we rallied from 12.5 all the way up. This is 15 here, all the way up to 32.5, 20 ticks, right? And it's moving very fast. And this is the problem, right? In markets that have a lot of volatility and they're moving around very quickly, you're going to get those big jumps. Oh my gosh, I got something bullish here. By the time, it's easy to look back on a chart and say, oh yeah, this was very bullish here, this bar, and I'm going to get long right here. Well, reality is you have that bullish information coming in here. By the time your order gets filled, right, if it's a market order, you're probably filled up here, 27, you're not getting it at 18 for sure, because it's just, you know, it just, by the time the order hits the market, market's already moved. By the time you hit click, market's already up here. That's one of the drawbacks of a range-based chart, in the sense of thinking that, you know, in a fast-moving market, your fill is going to be, you know, instantaneous, right? Look at this. This is 9:03 and 07 seconds. This bar closes in 2 seconds later. So even if you're like, oh, this is bullish, I can get long here. By the time you click market buy, it's filled up here at 31, all right, not at 25 and a half. So, you know, that was, to me, one of the drawbacks. When a market has a lot of volatility and is moving quickly, then that's going to happen, right? Perfect example, trade NASDAQ, trade MNQ, doesn't matter what type of chart. Click market, look at the price of where the market is trading when you click buy market to the time you get your fill. Sometimes it could be, you know, 3, 4, 5, 6 ticks worse than you're expecting. That's slippage. Okay, but not, again, not every market is going to exhibit slippage. You know, in sort of normal, you know, markets that don't have a lot of, you know, say volatility, but, you know, markets that move nice and slow, you know, like a 10-year note. Okay, 10 years, I look at treasuries, you know, 10 years, fives, bonds, ultra bonds, ultra 10s. I use a 4-range chart exclusively. I can't trade a time-based chart, and I'll talk about it why in a second. But if you're using a range-based chart, like this type of market, all right, if you click buy one at the market, you're filled basically at the offer. It doesn't, you know, the bid offer is extremely thick, extremely strong. So if you buy, you know, there's hundreds or even thousands on the bid and the offer, that it's got that liquidity. A market like NQ, MNQ, it doesn't have that type of liquidity, so you're going to experience that slippage. And again, you know, depending on which market you're trading, is going to determine what size range-based chart you want to use. So, for example, I had something on my mind I just wanted to cover really quick. I can't think of it. I can't remember. Sorry. If it comes back, I'll throw it in there. So why I use range-based charts on slow-moving markets that have a lot of volume, like treasuries, like 10 years. Compare this chart. Okay, let me just get the time-based chart here. Right, I'll even go. Well, a 5-minute chart is going to be a little bit better here. Let's see, a 5-minute chart in treasuries. Okay, you do get the movement. So imagine, right, if this was a you know, I don't know, 60-second chart here. Okay, like that, 1 minute. Okay, you're not going to get much trading the bid or the offer, right? You'd have to, you know, that's 60 seconds. You know, obviously you're not going to go less than that. If you're trading a 2-minute chart, you know, sometimes, you know, where people or fixate, you know, people trade a lot of different types of chart. A 2-minute chart is a little bit better in the sense of, at least now you have some price movements. You know, a 1-minute chart, not so much. You know, a 3-minute chart, a little bit better. Right, you're getting some price movements, but if it's on a quiet market, right, where it's just trading basically the bid and the offer, like here, you're not going to get much. You're going to say, well, you got a selling imbalance here, okay, but the only reason you got a selling imbalance is because it traded 12 here. If it got through right here, it was 1,075 trading at 12, but nothing traded because it was 12 offered, but it was 11.5 bid. If one contract traded here at 11.5, then I'd have a buying imbalance here and a selling imbalance there, just like here, right? 1, 2, 2, 6, 4 lots here. Okay, so that's an imbalance. It's hard to really get much in the sense of what is happening in the market on slow-moving markets that trade a lot of volume on a time-based chart. Or even, let me just rephrase that, it's hard to get a lot of information in the order flow on markets that don't move very much on a time-based chart. If you were to look at, you know, maybe let's take a look at HE, right? And HE is lean hogs. A lot of people don't trade lean hogs, but just to give you an example, well, Friday though we did have some nice price movement, but if you go back, hogs I believe sold off, but sort of on a normal trading day, right? It kind of looks like this for the most part. I mean, you do get bars that sort of come in, with bigger ranges, but this is a great market to trade order flow, by the way. It's not as sexy as the E-minis, but it is nice. Versus if you were to look at this that hog market on a range-based chart, okay? For a lot of traders, it's a little bit easier to grasp because bars now are consistent as opposed to, bar with 2 price levels, 3 price levels, and all of a sudden about 10 price levels. Then it contracts 2 price levels, 1 price level, 2 price levels, right? So if you're using a range-based chart, it's pretty consistent, okay? Obviously the volumes are going to be different. If the market is moving fast like it did on Friday, okay, here we got a drop, but it's still relatively slow, all right? This range-based chart is, at times about a 30-second chart. So there are pluses and minuses to trading range-based charts as opposed to time-based charts. For some traders, they tell me it preserves their sanity because there's less choppiness and noise they find on range charts, and as a result, that prevents overtrading and emotional trading, right? Emotional capital. So at the end of the day, really, it just comes down to what you're comfortable with, right? I said, I trade both. I look at both. It's really a personal decision. It's one of those things about putting the chart up on your screen that's going to help you understand the markets the most. Okay, so there's no point putting things on your screen that, a chart rather on your screen that isn't helpful to you in your trading, right? You want to have the most useful chart that's going to help you understand the market. It's going to help you understand what you're looking at, and more importantly, what you're trading. So anyway, guys, I hope you guys got something decent out of this video. That wraps up this video on range versus time-based charts. I hope you enjoyed this video. And again, if you haven't already subscribed, be sure to subscribe to the channel, and I'll see you guys on the next video. Bye-bye.